remember being in 6th grade when a couple of classmates said,
"Ah, I see your epidermis."
and I was like, what? Where?
In that moment, you don't know what to think. But then once you know what they're talking about, right? I'm like, wow, you're talking about my skin. Duh, of course you see my epidermis. Have you ever had one of those very uncomfortable moments where you either don't know what somebody's talking about or you're feeling overexposed? I'm gonna be honest with you, going through the pre-qualification process can definitely cause a person to feel that way, especially because of the terminology and acronyms that we use. So today we're going to be talking about a very important factor that we look at that's known as debt to income ratio, DTI. So your debt to income ratio is basically comparing your monthly debts such as credit cards, car payments, and student loans compared to your monthly gross income. And the way that you calculate that is by taking that monthly debt, think about things that are just on your credit report, and you're going to divide that by your gross monthly income. So this is your debt to income ratio, but let's talk about how you would go about calculating it. So when we're talking about gross income, let's be very specific and assume certain things, such as a full-time W-2 wage earner, because income is different for somebody who's self-employed or part-time or seasonal. So we're going to assume a full-time W-2 wage earner is making $72,000 a year. And we're going to divide that by 12 months. And that's going to give you a monthly gross income amount of $6,000. Now, when we're calculating your debt to income ratio, there are guidelines that determine what that maximum percentage can be. And so some of the factors that will determine that are predominantly your loan type. And that range can be anywhere between 43 to 56%. In this example though, to keep it simple, let's just say that the maximum allowable ratio is 50%. So we're gonna take 50% of that gross monthly income, and that means that you have $3,000 of disposable monthly income. Now you take that $3,000 of disposable income and subtract it by whatever your car payment is. Let's say it's $450 a month. And if you've got $250 a month of total credit card debt, you're gonna add that plus a student loan payment of $120. That's a total monthly debt of $820 that you're gonna subtract. And this means that you have about a little over $2,100 a month of disposable income that you can apply towards your new mortgage payment. So one of the most common questions that I get is, what happens if I need to buy a car? And so I've had several clients this year that wanted or needed to wait to buy till next year. And that commonly comes up. Well, if you buy a car and the car note's the same as you had before, $450, well, it doesn't do anything. But if that car payment's now $600, meaning your payment went up $150, and let's just say, you know, it's after the holidays, you did a little credit card spending, and now that monthly minimum payment increased by another $50. Your debts have increased by $200 a month. So if your monthly expenses increased by $200, you're gonna deduct that from this amount, meaning you only have $1,900, a little bit over that, to apply towards your mortgage payment. Well, that doesn't sound like much, right? But the truth is that a $200 difference in your debt can be the difference between $20,000 to $30,000 in how much home you can buy. So whether you're dreaming, thinking, or planning to buy in 2025, be sure to reach out so you know exactly where you stand with your debt to income ratio.